Hey, it's the Profit Answer Man, Rocky Lalvani. If you're new to the podcast, check out my interview with Mike Michalowicz. It's episode number 2. If you want to hear about each chapter in the Profit First book, go back and listen to episodes 3 through 13. Episode 1 is the why and how. On the Profit Answer Man, we learn money mastery without all the complicated accounting mumbo-jumbo using a simple system. Your accountant is busy documenting your transactions and creating a rearview mirror of what happened. My guess is you don't even look at the reports they sent you. If you're like most business owners, you struggle with this, and it's not your fault. We aren't taught money in school, and accountants aren't taught how to be profitable. The Profit First system created by Mike Michalowicz works, and he certified me to help you implement the system in your business. Remember, the new equation is sales minus profit equals expenses. Let's face it, without cash flow, you can't pay your employees, buy needed materials, or pay your mortgage and support your family. I help you to do that and more, so you can focus on the parts of the business you love and receive the rewards for your labor and investment into your business. The stronger you are as a business owner, the more jobs you create, the better we are as a country. Small business owners are the backbone of America, and for that, you deserve to be well rewarded. Just remember, more revenue does not equal more profit. That's why we focus on the bottom line. I have to say, one of my biggest expenses is taxes. And I hate to pay taxes, but I also understand that they are the price I pay for a highly profitable business. One way to reduce taxes while keeping and growing wealth is to use retirement plans. We touch on self-directed plans today that allow you to create higher streams of income for you to use later in life while getting a tax benefit today, depending on which ones you use. There are so many more options today, and many of my clients take advantage of these, and it allows them to grow tax-free wealth. Our guest is Dan Kryzanowski. He's an active capital raiser, equity owner, and passive investor, generating double-digit yields and lower taxes via commercial real estate. He's also the founding vice president at Rocket Dollar, where they're unlocking a $10 trillion pool of untapped retirement assets for alternative investment community. He's done commercial real estate and in a variety of areas, and he also does the self-directed solo 401ks and other types of plans. Let's meet Dan. Welcome to the Profit Answer Man, Dan K. It's great to have you join us today.
Awesome, brother. Great to be here.
Can you tell a little bit about your business and what you do?
Yeah, absolutely. So I raise capital for private real estate. I associate myself and have in the past with different brands. And behind the marketing, I'm my own LLC S Corp. So I'm a one-man shop, completely self-employed, and previously have done similar endeavors as a sole proprietor. So I've kind of, in some ways, stepped up my game in terms of the level of sophistication, but also the level of opportunity I feel that you have now being an LLC S Corp.
Cool. And we're going to dig into a lot of that today. So the biggest thing we all like to do is build tax-free wealth. How do we do that?
Yeah, well, the first, and I wish folks can see, your wonderful bookshelf, Profit First. And that's true. And for anybody, my fellow folks that are in year one, particularly if it was COVID related, yes, I feel you. I'm with you loud and clear on that. Tax-free wealth, I think, is a few ways. I think for folks, especially if you've been corporate previously, you realize a lot of the expenses that your corporation had, they wrote off. your salary, your office, to an extent, your meals, your supplies. So I think part of it is a shift in mindset to say, okay, so for me, not being corporate anymore, one is, is something business related. And frankly, a lot of us work 10, 12, 14 plus hours. So yes, I'd say be very open, honest at the same time, but you have a lot of expenses, which the net of that is you're going to have more money bottom line to have. You're going to lower your tax base that way. The second way is, once again, when you were W-2, it was kind of set it and forget it, your 401k. There's actually very similar plans, but they're a lot better in terms of what you can contribute, frankly, the ease from them and the net benefit you'll have from managing these plans, that you can be to the tune of over $50,000 a year. Multiply that by 2 if you're, say, a husband-wife team, that you lower your gross income, but also are putting that towards retirement. So those are 2 of the ways, right off the bat. And then third, I'd say, instead of just, as cash comes in, you can actually invest that out. I still feel confident in real estate that things can be invested for relative short term, from 6 months, a year, 3 years, where you're probably getting double-digit returns. And some of these can be very tax advantaged depending on who you go with. So these are just many of the ways that you get closer to tax zero, or frankly can just make more off of your money.
So let's talk a little bit. Certain types of opportunities are only available to certain types of people, called accredited investors. And as a business owner, many times you might be an accredited investor and not even know it. So can you explain what that is and what are the standards to become an accredited investor?
Sure. So starting with the latter, to be accredited, if you are filing of an individual $200,000 a year, married $300,000, or if you have $1 million net worth. Now, also, if you're Series 7 like I am, that checks the box really quickly. What I think a lot of folks, so I'm going to assume everybody's middle-aged or a little bit above here. $1 million sounds like a lot, but you may have come across this. How? Once again, what is included in here? It is your old 401k, probably now termed as an an IRA. You may have inherited something. I would argue that you have. Gold, physical possessions. Once again, the older generation or what we grew up with. It is possible all of this comes in. With the exception of your primary residence, all of this is included. I know some of us here own office buildings. I'm actually sitting in one right now where the owner is here. This building alone would make him accredited. So there's a lot of ways when you say, hey, listen, if stuff hit the fan and I had to liquidate everything, what can I get today? There's probably a decent chance you can get $1 million. That's probably a high level way to think about it.
And what about the value of the business itself?
Yeah, I mean, this is something that, yes, I consider, once again, if you're a sole, if you're an LLC, yes, this is something that should be in the calculation. And once again, your CPA and lawyer is the one, and/or lawyer makes this determination. And I just want to step back. The spirit of this, of accreditation, in my opinion, is so, grandma doesn't put her last 50,000 in some crazy startup idea. By default, most of us small business owners are, I'd say, very sophisticated in terms of our money and knowing what's going on and what we need. And frankly, probably most of all, business acumen from a gut feel and due diligence. So, once again, I feel it's an honest conversation to have, but I feel, most CPAs, lawyers are going to give you the benefit of the doubt if you're kind of hovering in those, high six figures, kind of adding everything up together.
And so we've talked a little bit about IRAs. One of the types of IRAs that is not so well known is the self-directed IRA. Can you share a little bit about what that is and the power of it?
Yeah. So, self-directed IRA, and I'm going to say, much like Scooby-Doo, it's the capital S, the capital D, not your lowercase, like, hey, I self-directed Fidelity because I have 10 mutual funds. No, that's not it. So self-directed IRAs, they've been around since the 70s. They're legal. Many politicians, probably many of our peers have had them. And the down the fairway kind of common experience is somebody worked, They have a bucket of money. They want to invest in their buddy's real estate deal. Say you have a buddy buying land, we're both from Pennsylvania, somewhere in Lancaster. Great. To access that money, you need a quote unquote self-directed IRA, SDIRA. Now there's different types. In a similar vein, there's also something called a self-directed solo 401k that I feel for some folks here, particularly if you are, say, a one-man, one-woman shop, a couple, and or if you do not, I'll repeat, do not have W-2 employees, this is a very powerful entity to not only qualify, but also contribute, and thereafter invest in passively and, frankly, almost anything you want.
And by investing in anything you want, we're talking real estate, we're talking you can actually loan out money to other real estate investors. I think the only thing that you cannot do is invest in yourself, right? You can't run your business through the IRA.
And I'll play, I'm not a lawyer, but I'll play one because I think this is great. Much like a health savings account, if you have one and, your child breaks his arm, well, you take him to the ER, you swipe this card, it's backed by some credit union, you're good. You and I go out and buy plush couches, probably not kosher. What's nice here is in this world of SDIRA, self-directed accounts, the Iras says what you cannot do. So no life insurance, no collectibles. And the big one, as you mentioned, Rocky, is not yourself or your linear family. So for example, I cannot buy a house at the Jersey Shore and I stay on it at the weekends. I can't invest in my kids' startup. My parents are going to come over once a month down the street. I can't buy a flat for them. Now, that said, pretty much everything else is in play domestic and also internationally. You want to buy a rental in Cancun, Mexico, you can do that. The one thing that's still kind of a gray area is cannabis. Rule of thumb is, if it's a strip mall with some hemp, that's fine. If it's the product itself, you're probably going to be a little cautious and don't want your IRA touching that. But everything else is pretty much in play.
And so what is the power? The power is that you get to invest your money and you don't pay taxes on it today as it grows. And then if it's a Roth, you essentially never pay taxes on it again. And some of you may have heard some of the people who have literally created millions upon millions of dollars of growth within their Roth IRAs, and they'll never have to pay taxes on it again.
No, and this is a great subject, and I know this has hit the headlines this year, so let me just talk on a few points. First, high level, let's address the headline. Peter Thiel, and I'll keep the politics aside. I would say growing up in Scranton and going to UPenn, I played baseball on Biden's childhood field, and I rode with Trump Jr., so, no mas about politics for me. But, with that as a background, I would say Peter Thiel won the lottery. It's almost like taxing the lottery winner twice. And I say this from a standpoint, it's difficult to invest in startups and just hit home run after home run after home run. I mean, it's pretty difficult. So, with that said, there's the other side, which really surprised me, is that what was proposed in DC was to also basically collapse and make it a royal headache for Joe and Jane America, regardless of what side of the political aisle you're on. I mean, I don't see how you're going to gain votes by just making it a nightmare for people's retirements and the good sponsors, including a lot of small business owners that have taken these sort of self-directed checks before. So I'm happy to speak offline with anybody further on that. But ultimately, I don't think it's going to go through. I think it's just some noise. I'm happy we're addressing it, especially, the seats that we're in here. But, with that, you're right. It's the seed versus the tree analogy in the Roth, whether it's a self-directed Roth IRA or within the solo 401k that I can go into detail in a minute. You're using post-tax dollars. Obviously, the flip side of that is, if this startup or whatever you invest in goes nowhere, well, not only did you pay taxes on your investment, but you're getting nothing on the back end. So once again, risk return. And then on a pre-tax standpoint, as many of us know from our W-2 days, well, this just grows tax-free for as long as possible. Now, the wild card here is, one, like anything, what you invested in is going to be worth something on the back end. Two, I think a big one here, particularly for our younger folks, is, what marginal tax rates are going to be there when you hit your 70s, et cetera. And then the third thing is just for personal. I mean, listen, I've been in Texas, but I grew up in Pennsylvania. If I move back to PA, well, guess what? I'm going to have state income tax again. Whoops, that might not be that fun, taking out money, let's say, assuming I was in my 60s now. So just a bunch of different cautions, especially that we do have mobility potentially where we can live or folks are resettling to think about as you think about not only probably more so your business, but also your overall portfolio.
You said a couple times you wanted to get into more details on some of these things. So why don't we do that?
Yeah. So the solo 401k, a lot of folks out here are self-employed. And what I mean by that, either you're 24/7, you and your spouse, once again, without W-2 employees in this entity are self-employed, or like myself, I have a small entity that is not about capital raising. It's just consulting on the side. But I do it honestly, and I do it for X hours a year. Why I share all this is that these activities, and once again, I'll caveat what it is not. It's not day trading. It's not collecting a rent check. It's quote unquote, I'll give you the technical term, doing stuff is what the government says. Are you doing stuff? And with this means you are eligible to open a solo 401k, also known as an individual 401k. Some other folks have fancy acronyms. But what this means is that much like your W-2 friends, the first 19,000 or so of income you can put into this account. Fantastic. So right off the bat, let's say your husband-wife team, your first 38 plus thousand, add a few more thousand if you're over 50. But the nice thing here, so basically at this point, you're kind of on par with your W-2 friends. The nice thing here is the profit share thereafter. So you're looking at about, let's just say you made 100,000. You're a one-man consultant. You have your 19,000. In addition, you can do 20% of your net earnings. So in our very simple example here, you're looking at 39,000 that you can lower your bottom line and then have in this retirement account, protect it. And the final bonus so this is just in terms of contributions. I'll take a pause here, but let's talk about the benefits of the account. The solo 401k, first of all, we mentioned SDIRA and Roth SDIRA. In this magical solo 401k world, you can have two checking accounts. One pre-tax, one post-tax. Once again, I'll caveat, if you move money from pre-tax to post-tax, you will pay on that, such as a Roth conversion. Okay? But what's nice about this is you may have a really good inkling on somebody's startup and say, listen, this 10,000 I'm going to invest in it. I'd rather pay taxes today than in 10 or 20 years. Other benefits for the self-employed person with the solo, you can borrow up to $50,000. So as long as you pay yourself back over 5 years. Why is this incredibly important? Well, once again, you may have an idea. You may stand up a new business line, a new LLC, and say, you know what? I don't want to ask for friends and family. I don't want to go to a bank yet. And I know if stuff really hits the fan, I'm either going to go back to my core business or maybe I go back to my W-2. You can borrow, up to 50K, so as long as you pay yourself back. Those, I'd say, are two of and there's other benefits too that go into it, but these, I think, are two of the largest benefits in terms of the contribution and the ability to borrow. And let's just say, for folks that have a really smooth business, how cash flow is going to play out. There's some more, I'd say, even savvier things that you can do to really, really maximize kind of what's going into these accounts. And it's probably more for an offline conversation, but it's out there.
And that's the situation. Everyone's situation is different. And so don't follow other people's plans. Figure out a plan that works for you and for your business. And I think that's one of the biggest things that I talk to business owners about. The number one expense for a lot of us is taxes. And by doing good retirement planning, you can save on taxes while keeping the money so that you don't have to go invest in something that you may or may not need. It's one of the quickest, fastest ways to lower your taxable income. And then, as we know, businesses are, the world is constantly changing. So building that second pile of wealth outside your business is also important because it gives you that safety net for the future.
Yeah, and this is a great point, Rocky, too. I think part of the mindset shift is that we're not two separate beings here, one until, 20 to 60 or 40 to 60 years old and then 60 thereafter. You have to think of, you're right, this is a full portfolio. And yes, some money I would prefer to keep on the side no matter what till I'm 60 plus, and vice versa. Some money I'd like to use and really keep active now. And then I'm more, as well dependent, but also looking forward to my retirement dollar after 60 for the different, much like Social Security, the 62 versus 70 sort of years old analogy. So I think that's a great point you made in terms of kind of looking at the full portfolio.
What else should we consider as we think about investing and building tax-free wealth?
Yeah, so I think it's where you what you invest in. And let me give a real example here is, and we all have our skills. Hopefully, let's talk real estate, commercial real estate. I like to draw out a triangle. I think, XYZ, ABC real estate, these guys are either great, marketers, sticks and bricks, or I call them banker types. I think more of the banker types that are a little more sophisticated, that understand the tax code well, you would want to invest with. So there's something out there. It's called return of capital, OF. And what this means is that although, let's just use round numbers, you invest $100,000 in a deal that's going to pay an 8% dividend. Well, you're going to get that $8,000 or distribution, it may be called. In addition, you're going to get a K1, which once again is very different than your checking account or investing otherwise, where you get a 1099. You get a K1 that's going to give you all these depreciation benefits. But on top of that, something called return of capital. And the net effect is on that $8,000 we're using in our example is that you should not be paying taxes on that because it's offset by an amount coded towards return of capital. And this will go on for the life of the deal. And then upon sale, there's other things that are converted that long and short is, let's just say you had a 4-year deal times 8%. This $32,000 from an ongoing basis and throughout the term, you should not be paying taxes on. So that's great. Now on the back end also, let's just say you're going to get an additional, call it $40,000 in profit share. This is a pretty meaty deal, let's say. You'll be paying long-term capital gains tax. So let's look at a scenario B. What most folks might do is say, hey, I'm going to put it in a stock. Well, you're paying on dividends. I'm going to put it in a bond. Great, but you're not getting anything else on the back. And that 100 that you put in, you're getting your dividends. And I'll preface, no bonds are paying 8%. So this is kind of a silly example. Let's call it 2%. Well, guess what? You're paying taxes on that, only $2,000 in our example you made here. And on the back end, you're only getting the $1,000 back, not the appreciation from real estate. So, it's kind of I'd say there's a dual benefit of real estate. And the more savvier the, I'd say, underwriter is, and obviously do your diligence talk, it can be extremely tax beneficial.
And they have to plan for that and do that up front, which is not always easy.
Well, it depends, just to close on that. It depends on talking to the operator. And a lot of times the operator will share this in their webinar, in their FAQ, getting to know you. So especially, I'll nerd out a second here. If it's a 506 Bravo, 506B, the sponsor really has to know you before even offering their deal. 506 Charlie is a little more broadly marketed, but can only take accredited investors. Either way, as an investor, you should have the conversation. I always get it, I'm a simple boy from Scranton, PA. It's like, hey, if I give you $100, what does this look like? Down in Texas, we say, how many tacos can we buy? I guess, how many pizzas and beers can we buy on Friday night back home? And that's, and if the operator really can't answer that, then that should be a pretty decent flag to say, maybe I move on to somebody else in the space.
What's one of the most surprising investments that you've seen people make?
Oh boy. I can look in the mirror here and I'll imply that question means, what's the silliest or, thing you did? I invested in a comedy tour. Made sense at the time. It was cute. Thomas Friedman's book, The World is Flat. It didn't play out that way. So we're sitting there with my wife saying, hope you like these tickets, sweetheart, because these might be $1,000 write-offs. And I predicted the future on that. But other things that I've seen, which let's talk about things that are beneficial for a small business owner, whether you're using your retirement dollars or otherwise. As the world reopens, especially down here in the Sun Belt, event space, it's expensive. You don't think about that. If you invest, let's just say in a bar, in a restaurant, there's a great restaurant I invested in, and they had a beautiful second floor space that I would go for mid-afternoon meetings or host. Now, normally this would cost me hundreds of dollars. But not only did I have a really cool kitschy space that played up to my brand, as an investor, I had half price drinks and food. And not saying we hit it too hard, I'm not in college anymore. But when you added this all up, is that even though, and I'll admit with this investment, and it was not a big investment, it did go to zero, but I feel the net benefits. I said, listen, even if this restaurant was open for a year, I would benefit because I was going to go for a quarterly event and host a few lunches there. So, I made out, I came out net ahead, even though the investment did not. So not saying you want to invest to lose, but call it my simple numbers. $1,000 was a tax write-off. Great. But in addition, I had all these other benefits with legitimate business expenses for meals, et cetera, et cetera. Once again, all above board, but it's also to think, what are you going to get other marginal benefits from? And cherry on top with me physically in Austin, Texas, I bet you a lot of folks are going to invest in Austin just to say, hey, look, I'm a super smart investor, or I get to now travel to Austin every 3 months. There's some of that out there. Like anything, play it to your network, see what you can go into, and that'd be my general advice. And trust me, you can fill in the blanks of things for better or worse that people have invested in before.
And so that was something interesting you said. If I invest in Austin, then my trips to Austin are tax deductible because I'm checking in on my investment.
Yeah, and I think that's a legitimate. It depends what your business is per se. But once again, if you're, I'm capital raising. So as I said, most likely you may be pitching something for a company you invested in. Let's call it. I don't know what the PC word is. Is it swag? Is it tchotchkes? Is it year-end stuff? But it would be legitimate. Say, listen, I'm going to fly to Austin. I have a good relationship with the company that I coincidentally invested in. They also introduced me to 3 other people that I'm going to call on. That's a legitimate. You chose, time and effort to travel here. There's legit expenses, and you're calling on prospects. So as I said, it's, if you think of both sides of the coin, one, you have the write-offs, but also if you're getting these, in our little example, 3 warm intros, well, hey, maybe another one becomes your client. This can work.
You got to think through all of this stuff and be intentional about what you're doing and how you're doing it. And then when you build your life that way, then everything else kind of falls into place. Go ahead.
Just another, I go back. I said, I grew up, my dad was a high school principal, my mom was a social worker. They have pensions. And the thought of like, hey, how much of our basement are we going to write off really wasn't top of mind. When I went to Wharton, that really wasn't talked about. And then all my smart friends that are working for PE shops, yes, they have more money than God. Actually, their company has more money than God, but they're doing all right. But I think now, once again, some of us are legitimately working from home. Some of it's our second office. I think you have to think, and this is all in the tax code, legal, it's been around forever, is like, hey, I'm using this physical space. This is another write-off, that's going into it. So it's once again, it's the mind shift, particularly for folks that, what do they call it? The reluctant entrepreneur stage of your life. Especially early on, it's much like a parent. If you were a new parent, you're going to take some help where you can get it. So for my fellow kind of new SMB operators out there, talk to somebody that's been in the space a few years, compare notes on the taxes, what you're going to write off. And I think it's going to be pretty beneficial in your favor from that 1 cup of coffee conversation.
Is there anything that we should touch on that we have not already done so?
No, I think a big takeaway is the solo 401k if you are self-employed. If you're having a good year and you think taxes are going to go up a lot, a Roth conversion is something to think about this year. Or on the flip side, you're not having a good year, but this is year 0. Next year, you're going to crush it. Well, let's say, I'll keep the example simple. You're taking 0 salary this year. Maybe you do that Roth conversion, for 50K, 100K, up to frankly, 200 plus K, because next year when you make your X 100,000, well, you're in a different tax bracket. So it's a little thing, but I also say, like the Band-Aid, I'd say if you have the ability to just pull it off at once and you have the liquidity, trust me, now through 2026 is probably going to be the best time to do that sort of Roth conversion strategy. And I don't know if we'll have it in the show notes, but as we joke, if you can spell it, you can get it. I was an advisor and investor, and I actually did a Roth conversion to invest with Rocket Dollar. And they have a great expertise in solo 401k. So I like to joke, if you can spell it, you can get it. D. Kryzanowski, it's 12 characters. That'll give you half of Ben Franklin off, opening your solo 401k.
Cool. And we will put that in the show notes. What's the best way for people to find you and connect?
Yeah, LinkedIn is great. And, please mention that, you're listening to Rocky. And, I love LinkedIn and I'm great on it. And so please mention, happy to do one-on-one calls with anybody here.
Cool. And I will put your LinkedIn profile in the show notes. Thank you so much for joining us today.
Such a pleasure. Thanks, Ron.
The Self-Directed IRA is a powerful tool that many wealthy people use. My goal today was just to introduce you to the concept. Everyone has a different strategy to building wealth. At the core is making sure you are profitable and can remove that cash from your business and then come up with a plan that best fits your needs to make it grow and create other streams of income for you and for your family. Remember, you don't need more resources, you need to be more resourceful. We focus on the bottom line. If you want a done-for-you service, you can have me as your Chief Profitability Officer because you have your zone of genius and want to spend your time doing what you love. I only work with a handful of clients, so they get my full attention. I work with business owners who have or are growing to $500,000 to $5 million in revenue. You can use the scheduling link in the show notes to get on my calendar for a good fit conversation to see if I'm the right person to support you and how I can help you. If you want to learn about living the life of your dreams, check out my other podcast, Richer Soul. As we close out, let's repeat the mantra. Revenue is vanity, profit is sanity, and cash is king. Have an abundant and profitable week.